should be sent in. Hello everyone, welcome to today's strategy development. Sorry, I was just putting the link in there to the Discord. Yeah, that should be it. Awesome. Okay. Yeah, welcome everyone. We're going to do another one again. Rob, how we doing? Everything good today? Yeah, we're going to do another, obviously, build as usual on the Tuesday streams. This one is not going to be price action based. It's something that everyone will know, but it's a case of do they actually work? How do we build them? And could we get it in our charity Darwin portfolio? Just having a quick scan of the market, seeing that they're actually moving quite a lot. We've got lots of moves at the moment. NASDAQ falling down. Japanese yen really falling. Japanese yen. The Nikkei, Japanese index, really falling off as well. So interested to see how these are all getting on. But yeah, again, we're just going back to trusted Oxford capital strategies. We can keep going through these until we come and we hit a wall, and then obviously we went over a sort of trading generator tool that we went over. I think it was on Wednesday or Thursday. Can't remember which day. But yeah, then once we've done most of these things, then we'll definitely move on to sort of some more generic randomization, or we can find other resources as well. There's plenty of resources out there. We could just continuously build. So yeah, today we're going to do gaps, something that probably people overlook and have not really know how to sort of automate it. I mean, it's actually a very easy thing to automate. And according to Oxford Strategy, this is something that works well on the markets that have been traded. So again, if you're not too sure on how to build these sort of systems while looking at this, you can use Trusty Claude or ChatGPT and just tell it to explain it, as if you're a beginner. And one of the easiest ways to kind of go about it as well is say, refer to yesterday's candle or the past candle to candle 1, the candle 4 up to candle 2, and the current candle 0, just so then you're getting into the habit of teaching it what you're defining each candle is, because that's exactly what we use in FX Dream essentially. If we go to candles here, we can see that more settings, candle 0 is current candle 1 is the past candle, and obviously candle 2, 3, 4, 5, all previous candles. So if we tell Claude or any sort of LLM what it is that we're actually defining, these things get a little bit more easier. So to give a little bit of context to the setup, it's the low of the current bar is above the high of the previous bar. So this is low of 0 is above the high of 1. Short is the complete opposite. And the filter that we're going to be building today is upper channel is the highest high over a period filter or look back. Lower channel is the lowest low. So if the high is above, of the high of 0 is above the channel of upper channel of 1 or whatever the look back is, then we're trading. So to give a little bit of context is let's have a quick look and see if we can find any gaps on this, any decent sized gaps that we might find. Okay, yeah. So we can see that the low is above the high and the high is above the look back period. So let's say it's 5 bars. We can say that this is above the past 5 bars. We would then look to buy here and probably get out at end of day. That's an easy one to do. I think the exits are after end days or end time index. So again, these are things that we can always sort of optimize, have a look at. And again, it uses like a stop loss as multiples of ATR. I mean, always in Oxford Strat, the ATR stops are always 6 multiples, but again, that might not be the best. We might find better ways to go about it. Okay, so yeah, simple enough. Let's kind of build this strategy and kind of go through where people might go wrong with this and the easiest way to go about it. So gap trading. Obviously, gap trading can happen at any given time, but we want to more focus on probably weekend gaps rather than anything, because on some indices or anything, you're probably going to get some gaps during the week. And I would say they're less meaningful, if that makes sense. Whereas, the weekend gaps can be a bit more meaningful. So what we want to do is we want to go on to, so let me just zoom in here. We want to do, first and foremost, we want to sort of set a once per week, so once per bar, and once per week, because we could say once per bar on a Monday, but not always. The market might not open on a Monday, if that makes sense. Sometimes it could be a Tuesday. It depends on holidays, things like this. So the easiest way to go about it is once per bar on the weekly time frame. Okay. So what we need to do is we then need to say for longs. So a long gap is the low. Oh, wrong one. The low of 0 is above the high of 1. I'm going to move this here and this here, just because that's going to be a bit easier for me. So then we're doing candle high of 1. Okay. Just because we're doing once per bar on the weekly does not mean that that's where we're going to take it. I think it's going to be a bit easier if we go to like a 1 hour time frame. So then it's a case of we're looking at the 1 hour rather than the sort of like weekly, because then it might just not work as well. And it's easier for it to identify a gap if we look at the 1 hour chart over like the weekly as well. So the easiest way to go about it is this way. So yeah. That's for that. And short, so we need the high of the current. Is that short? Sorry, did I put the low? Yeah, the low is above the high. And we need the high of 0 to be below the low of 1. Yeah. Very simple. Now, it's going to be interesting to see how long and short work. I feel, gaps down into the long, like mean reverting, could be a good idea. But we'll see how this works out first, and then what I'll do is we'll then probably change it a little bit, because I have a feeling that if we do like a sort of mean reversion play, so if it gaps down, we then buy and like hold until the end of the day. If it gaps up, we then short until the end of the day. We can test these both out, no problem whatsoever. So yeah, long trade, high of current is above the channel of whatever the look back is. So we'll do that. So high of 0 is above the highest price of, we do from 1 to whatever the look back. So we're going to create a constant. We're going to call it look back. Again, this is something that we can optimize. Let's just put 10. What's it optimizing back to? So it's optimizing in look backs of 2 to 100. So we can do the exact same. So we'll stick it at 2. Look back of channel. Easy enough. So then we'll make this a constant, so then we can actually do it like that. Yeah, and then we now need to do the short side. So it's going to be a very, very simple system again to build. Sometimes like these are the best ones to kind of build, the simpler ones. So the low is below the lowest price. Again, 1, 2, look back at 2. Again, we're going to optimize these sort of things as well. That's fine. So what we want to do though is, because we don't want to get in when the market opens straight away, because we could have a problem with, say, spreads or anything like that. So what might be worthwhile doing is we then have like a sort of spread filter. So rather than press buy or sell like from this point, what we're going to do is I'm going to create like an on-off switch. So we can do buy, and then we'll do sell. This is quite a good way to do it if you're wanting to kind of get in probably just around like near the open, but we want to wait until spreads calm down, because you don't want to be taking unnecessary costs, because as much as they might not seem too much on each individual trade, if we do this over hundreds, thousands of trades, an extra 2, 3, 4, 5 pips of costing of each trade, it really does add up. So it's quite essential that we get in when spreads are at its lowest. So we'll do buy, set this to 1. So this is going to be slightly different than what we do today. And then sells, we need to set this to 1 as well. So very simple. If we're doing a switch, one thing that I always get into the habit do is every single bar, we're resetting them anyway, okay? Easiest way to go about it. So then we don't need to worry about it, not like, because it could just be once it's activated once, then we go to the next week. Maybe there is no gap, but we're still taking the trade, if that makes sense. So yeah, easiest ways to go about it like this. We then go to the on tick timer. So we're using both on timer and on tick today. So on timer, we're just creating the conditions. On tick, this is where we're going to do our trading. So no position. Let's add in a spread filter, and then let's sort of again, this will probably vary from market to market, if that makes sense. So we'll put 1,000 for now, but again, we can edit this within MetaTrader. Spread. This isn't going to be our final value. We can edit this within MetaTrader. So spread, what we want to do is, so we're going to do value, and this is where we're then seeing if the switch is on or off. So if buy equals 1, it means that we can buy, okay? Probably this is slightly different for everyone that's been in this before. So this is like a new way of doing it, and it's just creating like switches more than anything. So we've got our condition, we've turned it on to 1. If it equals 1, then we know it's a place that we can start buying, if that makes sense. And again, after this, we want to reset the buy variable to 0, because then we don't want to keep taking buys, because if we leave that on, it'll just constantly keep taking buys. We only want one position. I mean, to be honest, we've still got our no position here, so that protects us, but it's just an added layer of protection, to be fair. So with your risk per balance, keep it simple at 1%. We're going to do probably no take profit. We're going to test loads of different methods out here. So we'll test end of day first. Then we can test, say, multiple days. And then if the multiple days does work, like we can actually hold the trades for longer. Then it might be worthwhile putting a sort of trailing management onto it. But I don't think it's going to be the best. I think we're just kind of, for me, gap, we're taking advantage of it gapping down or up. In this case, we're gapping up and we're buying. And if it gaps down, we're selling. Again, we're just following the rules here. But I'd be more inclined to test it the opposite way around. But again, we can do that after this. We can see what the results are like first. Again, we're going to create a multiple. So we'll do multiple. So we'll call it M. We'll take this to 3 multiples of ATR. Again, we'll create our time frame. So add on time frames. This will be our SL TF or SL time frame period. Let's just do H1. So it means we can right click in here. And then here we're just going to do times M. So this is just going to times the ATR by whatever we put M as. And again, we can optimize that if we want to. But yeah, that's the buy side. So very simple, very straightforward. We now just need to replicate the sell side. So again, we're moving to value. We'll look at sell equals value 1. And then we'll look to put the sell side in here as well. The sell block, again, risk of 1%. Custom price fraction, average true range. Again, just follow that. Always just use like 20. You can use whatever sort of period you want. I mean, it's not going to make a massive amount of difference. Use the last candle stop loss, and again, times M, take away the take profit. Okay, and again, we need to reset this as well. Okay. So we've now created the system, very simple. 8 blocks here, 8 blocks here. Now we just need to be able to close out the position. So let's do once per day at a certain hour. Let's just do it simple. Let's do 8 o'clock at night. So let's do let's just do 21.59. So just a 1 minute before 8 o'clock at night. So then we're really taking advantage of the whole day. We then close positions. Okay. Very simple, very straightforward. We don't really need to worry about resetting the node at this time because we would have taken the trade already if we were in a gap trade. So yeah, very simple. Okay. Let me now just get MetaTrader up and we can have a quick little test. So let me just load it up. Why is this not working? Should have had this prepped. Downloads. There we go. Gaps. Awesome, awesome, awesome. So let me just move this away. Let me get this across. Okay. Right, okay. So ignore that. Let's go to gaps. I really need to clean this up. And I need to know my alphabet. Where would it be? Gaps, there we go. Okay, so what we can do is we can test it on all sort of symbols. We'll do from, I mean, to be honest, like there's not really too much of a great deal we can do here as such. Maybe we can see what kind of works if we extend the multiplier to like 5 times, right? Maybe we just go one by one because we can then change the loopback as well as the multiplier. Maybe we just go one by one. I'm going to start with indices first, just because indices are normally quite strong and everything. But again, this could be one that's better on the other hand. So what we're doing is we'll, again, when a gap down, we then buy. When it gaps up, we then sell. It's possible that that works the best. So let's do 100. Let's do 2, 1, 6. So it means that we're doing loop back 2 in steps of 2 up to 100 and multiplier 2 in steps of 1 to 6. This is going to give us 250 different variations of this strategy. I mean, it's the exact same entry. It's just going to be different sort of levels for optimization. So let's just run it quite quickly. It shouldn't take too long because we're running it on the 1 minute open, high, low, close, just for simples. Then we can run it on obviously every tick. So yeah, interesting. So the problem is because we're looking at gaps, there's probably not going to be too many trades. Loop back 6. But what we want to kind of see is it kind of work across the board. I would say like this is a strategy that, you know, if we choose a loop back a 6, we want it to work on lots of different assets as well, because there's not too much we can do in terms of optimization as such. Right now, this is about, okay, I've put it on 40,000. Let's stop and let's put it on 100 just to make it easy. Take a couple of minutes again, won't be too long. But yeah, we can test it this way, then we can test the opposite way and see what's better. Yeah, so 5% return with a 7% drawdown. So nothing to really write home about. Because what we'll do is if we test it on this, we do like the 6 loop back and then 2 multiples. Maybe we test that on all of them. Although 2 multiples is quite small. 2 times 1 hour ATR for that. I don't know if I would go with that. Maybe 3. good thing is it's showing a lot of positive results, but if it's not going to make too much of a difference. It's not like we're really changing too much. If anything, like if it works on the 2 loopback, it's going to work on the rest of the loopbacks. Yeah, so not many trades, but then again, if we go on the charts, right? And we're looking at, is this S&P or NASDAQ? NASDAQ. If it wants to come up. So if we actually look on the NASDAQ chart, there's not gap up here, but it's not above the past 5. So we wouldn't have taken this trade. We'd have taken this trade. So we've gapped up. The high is above the past 5. So this is a trade we would have been in a couple of weeks ago. So we'd have probably been in somewhere around here. If we were to look at multiple hours of ATR, so average true range, let's change that to 20. Just to be consistent if it wants to, maybe not. And then we take, yes, the last candle, so 181, so then it would be about 363. And we'd have got out around about here. So this would have been a really good trade based on the logic. So maybe for NASDAQ, it's better when we do gaps up and we're closing above. Naturally, probably longs are going to work a lot better than shorts. But then again, this is up to me just presuming, maybe it's not like that. Again, here's another example of another trade. We gap up. The high is above the past X bars, getting somewhere around here. We'd have about 200, and we'd got out. Yeah, so this one probably wouldn't have got out till here. So this is where, yeah, okay, so there's a gap there. Okay, it'd have probably got out somewhere around there. Again, looking back, nothing much too obvious. Another trade would have got in here. So maybe it's not actually taking all the trades we're wanting it to do. I'd be interested to test it in terms of looking at our areas. So let's do the 2 look back, have a look at how it looks. Going through long periods and not trading, which concerns me a little. That's fine. Just gonna have a quick look to see, are we missing any gaps here? Maybe we're not. Did I change it to the low? No, wrong one. Are you analyzing Darwin's today? No, come back on Thursday. We do analysis of Darwin's on Thursday. I don't know where I've put the gaps. Is it on this one? Must be. So the low is below the low slope of 1 to 5. Yeah, okay, so that should work. Just having a quick look. Okay. Was a gap up, but nothing crazy. Gap up, but nothing crazy. Nice gap up. So maybe we could put something like we want a decent sized gap. It's possible. Yeah, again, gap up, perfectly fine. Okay. Let's just test this out of sample because we've already kind of had a look at the charts ourselves and found examples where it did work. It'd be good to see if we can probably test this period to see if it does work. Okay, so something is not working right with the NASDAQ data. Okay, interesting. Never had this one before. Strange. Very, very strange. Let me just be crazy there and do that. Okay. Let me just check this one. Okay, so that's working fine. It's just the NASDAQ. Okay, weird. So let's go back to the start and let's say we're looking at the S&P because we kind of want to base it on that because obviously there was data there that wasn't working. So we'll do this again. Tanya, how we doing? You all good? So we'll have a look at it this way. We'll look at the S. Start on the S&P, then we'll work our way as well. Okay. Yeah. So okay, this is looking better already. 88 trades. This is kind of a lot better. Look back being bigger. Okay, so maybe we're basically saying, when we gap up and it's higher than the past 100 bars, 50 bars, whatever it is, we're not going to go for a random 84. We'll take like a whole number that kind of makes sense. So what we'll do is we'll wait till this is done. We'll look at the sort of 2D. Then we can have a quick look at it, see how it gets on, see if it's profitable, check the out of sample. Then what we can do is we'll probably go and do like a big sort of market not optimization, but just to test it across the broader market, see what it works on, what it doesn't, and then for the things that don't work, maybe we then flip the bias and say when we're gap down and we're made the lowest low, then we then look to buy. Both scenarios could work. It seems. I know it's still doing. I just didn't see this load, so nice. Yeah, so a look back of 100 could be better, and it just means that we stick with that. Okay, start to look a bit better again. We'll have a look, and then we can make a decision. But it's looking like across the board, it's a reasonably good, profitable strategy for the most part. Still got a lot more to come in, so. And again, I think the good thing about maybe having something like this within the charity Darwin, if we can get this working across multiple markets, this is quite good. As in, rather than it be more, breakout strategies or what we've been building, this is completely different. So it's always good to kind of add diversification that way. And this is us just simply testing the gap. Maybe there is a much better way to go around it. To be honest, Rob, like where I live, I think everyone's been having a heat wave down in England where yesterday it was 17 degrees here, so nothing to write home about. And what's the weather today? All right, okay. Completely different. It's 24 today. I do have an aircon below me, so it's all good. But yeah, that's surprising. I didn't think it was that hot. Maybe I'll have to get the barbecue on after the stream. Okay. Let's look at the 1D. Okay, so we can safely say that around this area, the hotspot's not very good. Our best values are 32. Damn, that's quite hot. We can see our best values are here. I'd be inclined to probably choose here because the drop-off happens more 26. 40 seems okay, anything below 40. So 30 seems not too bad as well, but the drop-off to 20 there. Again, I would say anything past 40 is reasonably stable, to be honest. Reasonably stable. In terms of our look back, in terms of multiplier, what is the difference? Let's have a look at 40s. So multiplier 3 reduces by half, but then drawdown Maybe the trade-off is not worth it there. Definitely not worth it there. If we use 3% with 10, 4, yeah. I'd be more inclined to go here. Just for now. So 1.44 profit factor, but going both long and short. We can see longs are definitely better. Naturally, you would say. So let's have a quick test out of sample. Hopefully this works out of sample and then it validates the strategy. Sort of. It makes new equity highs. That's the good thing. Profit factor doesn't really change too much. But we can see there is a heavy, the longs are working very well here. So sounds quite crazy, but we could create like a double long. So like if we're below, we're looking to long. If we're gapping above, we're looking to long. But that's really taking advantage of the long bias. Might be worthwhile trying out, maybe not. So there we go. We've got our 9% return with 3.95% drawdown, equity 5.52. So nothing really to write home about. But this could be quite decent if we then cross market it. So what I'm going to do is I'm going to do all markets on watch. I need to clear some up. So let me get rid of I was testing some stocks earlier just to kind of see if I can get anything. Hopefully they've all cleared. Yeah, we're all good there. Don't need that. Turn that off. Turn that off. Okay, I think we're okay. Yeah, I'm going to go with that. That's fine. So we'll run across validation. And what I really want to see here is it to kind of work across the board on multiple different assets. Maybe it will, maybe it won't. But if we can, then it means that it's reasonably viable. So we're going to see a variation of results here. Quite a lot in the red. And again, this is probably a strategy that we want to sort of verify these results as well. So what might be good is if we use like download data. So, what I use is Quant Data Manager. You can get it for free. It has the Darwinex tick data as well as Dukas copies. So we could get longer term data for a lot of these things that work. And I would recommend sort of going down that path just to make sure that you're validating these. Okay, so weirdly, we picked the best market to trade on. Strange. And again, it looks like for the most part, currencies is a no-go here. But if we look at commodities as well as our equities here, maybe it is worthwhile here because we're getting some decent profit factors. So again, 9 on Nasdaq. Let's ignore that. We know that there's going to be probably a lot more on there. Dollar yen interestingly works. UK 100 interestingly works as well. So that's an interesting market that don't have anything to trade on. We've never traded it, so could be quite interesting. And I'm concerned about these gaps. Okay. Maybe we'll run this low risk on the chart of Darwin just to get some gap exposure. But we could say safely across the board it's working on the UK 100, the SP 500, the Nasdaq. It's working on gold and silver, which is interesting as well. It's working on the Nikkei as well slightly, but again, this data is unreliable at the moment. And dollar yen, I think I would skip this because there's no sort of it's not backing up the theory that it works because it doesn't work on any other currency. Where the S&P, it works on the S&P, it validates, it works on the Nasdaq, which is good. Gold, it works on silver, so similar markets. So we'll probably just stick to gold, and we'll probably just stick to the S&P. Maybe we can add the UK 100 in as well. But again, not too bad. Interesting market. What would be quite interesting is if we can sort of zoom out, right? We'll be able to see, are we cutting it short by only holding for so long, or are we not? So you can see here we've got short, so we kind of took the maximum we did. We got long here. Again, there would have been a pullback, so not too good. We got long here. So I think we got stopped out here. So yeah, we could have maybe held this one, couldn't have held this one, could not have held this one, could not have held this one, not really in this one, not really. So yeah, we're kind of validating the idea that closing at the end of the day is probably our best option here, unless we really do sort of say we're going to put the stop loss at the low of the last day and then hold to the end of the week. That's another possibility. But to me, we're not really seeing too much to confirm that. Maybe here, put stop loss here, get out at the end of the week here would have worked. Here, it would not have worked. Here, it would have worked. Here, it would have worked. I think that there is probably a lot more gaps here. So maybe we could get rid of it here, definitely. Yeah, so this would have been a massive win here. Again, that'd have been a big win. That'd have been a loss. So maybe there's multiple ways we can skin the strategy as such. And maybe we could have both. So, no, wrong one again. There's a lot more scammers come up again. Maybe what we could do is we could say, this is where we can have different ways of getting out of the market. So we're going to group these, right? So we're going to call this group one, and this has to be done by group. So what we'll do is we'll then create another buy position. So we're taking two buy positions, but what we'll do is we'll half the risk on it, right? So we'll do price level, and for the buys, we'll do candle low of 1 on the daily. So yeah, that's fine. We'll call that, we'll get rid of that and we'll call it group 2. Again, we'll do the same for the sell side, because maybe it's good to sort of like have a bit more diversification, as in rather than just looking at intraday, we're looking at sort of long-term hold. Candle high 1 daily. Okay, so then do once per day, weekday on the Friday, close position for group 2. The only problem that we have with this is it's not going to take in consideration holidays. So again, you might have like some massive trade that looks like it's holding for a long time. Do look back when you're looking at your like trades on the MetaTrader, because then this is a way to gauge, is this an anomaly or is this something that you then just need to add a little bit more extra code into to be able to sort of cut that one out, if that makes sense. Right, okay, so gaps 2. So our look back was 40. Our original result was 9% with a 3.95. We need to split this in 2. So, okay. I thought I put my risk as a constant. Obviously not. So this is going to risk 1% position. But what we want to see is we want to see this probably less than 10% drawdown with about 20% return. So maybe. Yeah, okay. So actually, in fact, it's not. So we've got that one there, out there. Yeah, okay. So it's actually not improved the strategy, I would say, at all. It's actually made it worse. So that can get rid of that theory. What's interesting again is the short sizes went down, the long sizes went up. So really interesting there. Let's test the same sort of method on gold. So It's maybe improved it. Gap up. See, that's a gap up as well, I would think. So I do not know why it's not taking that trade. Again, that's a gap up. It's not taking that trade. Okay, so maybe there is something slightly wrong in the way that it's taking trades. Let's go back to the drawing board. So we'll do that. So when the low is above the high, it should be fairly easy on the one of it. Let's change it to open. Probably makes a bit more sense, the open rather than the high. Because we're just literally looking for the gap. Let me disable the bigger ones. And let's see if that changes how many trades we're taking. Because I want to make sure that we're taking all the trades that we're meant to be taking. So we go back to the S&P. Let's just make sure we are getting, hopefully we're getting the exact same result. If we're not, then it just means that it was definitely missing. So look back 43, yeah, that's fine. So yeah, so roughly the same. That's fine. One thing that's quite important as well is, right, so see when we're building these systems, always look at your back test in terms of make sure that it's taking every trade. If it's not, you need to ask the question as to why. So for me here, this should have been a trade. I want to know why it did not take it. Again here, 1, 2, 3, 4. Okay, 40. Okay, so that's probably because it's not the past 40 bars. So let me just see if we change this to 5, is it taking these trades? So let's go back to that trade, and then hopefully we see it be taken, and then we know that the logic's 100%. Although I don't know where it was. Yeah, there we go. Okay, so logic's 100%. That's fine. Okay. So we know the long side, if we go back to the 41, just want to see what the actual end result was for it. Okay, so we know the end result is 60% to the long side, 39% to the short side. That does not mean that it might actually be profitable. It might just be, it's a low win rate. We'd need to double check that. Again, we can use something like Quant Analyzer or something else like that. But what I want to see is the other ones that we got working on UQ100. Is it also the long side? Because if it is, then that might be worthwhile just having a sort of long only gap, taking advantage of gaps. No, okay, short side more. Again, it's kind of, we can't just say we're going to cut out the longs here, cut out the shorts. There's just not enough trades. I want to make a collective sort of decision across the whole range of assets rather than just sort of, because we're not got lots of trades, we don't want to over optimize each one. Okay, 50-50, so nothing really too concerning there. Let's ignore NASDAQ as well. Let's try silver. Yeah, again, 50. Long side seems to be better apart from the UK 100. So that's interesting. The rest, not good whatsoever. Not good whatsoever. So it could be quite interesting, right? So we've got so many negative values here, where the problem is, like, we need to see, like, if we flip the results on this, so we'll flip the logic that whenever we're gapping up and we're making a high, we sell. Are we going to get these? Are these going to reverse the results? Because again, we're just kind of holding it open to see if we get that sort of result. So let's go back and just flip the bias. So let's kind of get rid of this. This is kind of not valid for me at the moment. What we want to do is, so we need to switch these around. Let's call it rev, because we've reversed the rules. So since we reversed the rules, just do a quick little optimization again, just to kind of see where things are at. So the worst market, that's not the worst market. That could be the worst market. So Aussie Swiss, see if we can get anything on Aussie Swiss. Again, these markets have massive spreads as well. So maybe if we put this down to something like 4, 5, because we don't want to be taking trades when it's massive. This was a 40 look back, so we'll do look back 40, and I think it was a multiple of 3. Hopefully, this will give us a positive result. If not, I want to know why. Okay, so it's not 100%. Again, we've gapped down, but we've got in here. So we can see that the difference between where we want to get in and where we don't is massive. Something to take into consideration. Getting in here because the spread was obviously not too bad. Gap up here. Yeah, okay. Makes sense. Gapped. Makes sense. Yeah, I think what we want to do is just kind of see, have these bigger gaps. Gaps don't happen all the time. Again, this would have been a really nice one if we had a bigger stop loss. Gap down, not below 40. There's probably quite a lot that we can do. We're just testing the general idea out pretty quickly. Again, nice trade. Okay. So let's now test it across all symbols. See, because we flipped the rules, are we getting a sort of change in results for these assets? Might not, might do. Just have to see. Okay, so you can see that we've got slight change. Again, there's certain assets that just not much there. Ignore this because this is not a real result because the contract sizing. Okay, so we can see if we flip the sort of bias here, the results are actually a lot better. Maybe the 40 is not good. Let's do something. Let's see. Let's try and get as many sort of trades as possible. I prefer to have more trades to validate the idea than not. Again, I don't think I've ever got anything to work on gas. Okay. Interesting that we flip the results and gold works on this side as well. Okay, so that's a really interesting market it works on. Makes sense though, Aussie, New Zealand. Not too bad, not too bad. Not too bad at all. So I'm trying to like see what we could put together. I mean, for me, like this would be more. This is a different way of putting a portfolio together. Yeah. Okay. So again, makes new equity highs. So again, maybe the 5. We did get better results with the 40. We got more results with the 40. Gold. That's interesting. So you could trade it both ways, and it works. Ah, no, it doesn't. Yeah, okay, that validates it. Yeah, okay. Let's just stick to the 40 because it just means both sides we're looking at 40. Maybe we can apply the S&P, UK 100, gold, NASDAQ. So what did we get actually that worked on this? Again, actually, it doesn't matter because we're not optimizing this at all. Let's see what works. I pressed the wrong button. All symbols, see what works. See if we can, then what I'll do is we'll do our usual, we'll de-risk it, see how it works within the large portfolio. So I'll just do that now while we're here. So we'll do the usual 0.01. Go back. The problem is we're really not going to get, like, it's not going to be a strategy that's going to return much. So it'll get to the point where, is it worth it? Because what we want to do, like, maybe we'd want to risk a little bit more on this. We'd maybe want to risk a little bit more on this, but we need to take into consideration that we can't risk 1% on this and 0.1% the rest of the time because we've got to take into account our value at risk. So it would see probably this as over risking compared to like the rest of our activity. Maybe it wouldn't actually. No, because it would go on contract size. Ignore that actually. We could probably risk a little bit more on these sort of systems just to kind of make sure that we're kind of keeping up with the general pace of everything else. I'd be more inclined to trade more of these to sort of take advantage as a collective of the gaps. So again, that's not too bad. Maybe what we'll do is we'll increase the risk to 0.2, see how it affects the portfolio overall, and then take it from there. So yeah, I think that's what we'll do for tomorrow. We'll see if we can add some of these into the portfolio, see what it looks like collectively, to see is it even worth us trading it? Does it make an impact to the portfolio and everything else like that? That could be quite interesting. We've got it both working both sides. So we've got it working when it gaps up and we're buying, but we've also got it working when it gaps up and we're selling. So we're trading like pure, like I think by the end of it, we could have quite a lot of assets. So I mean, I would need to fix the contract sizing on this with probably Claude. But again, it kind of looks like it's worth it on the Dow. It does look like it's worth it on the Dow to trade as well. So maybe I'll fix the contract sizing and then we can get it to work on the Dow because it's working. This is a lot of working here. We've got more working on this side than we do the other side, so I'd be more inclined to just stick with this side. If we look at it in profit factor, we've got a lot of higher profit factors here. Even like markets that I've never even looked at trading. So this could be like really good to have like a multi-market sort of, like we've got volume because we're trading on loads of different assets, if that makes sense. Rather than just a single asset with like 1,000 trades, we could get 60 trades here, 80 trades here, 66 trades here, 27 there, 41 here, 61 here. And then together it's probably going to make up maybe about 400 or 500 trades. And then we get to see it as a portfolio. It might be worthwhile doing that because we've got a lot of good profit factors here. I'm doing good, man. How are you doing as well? Thanks for joining me today. I mean, to be fair, you're probably joining like right at the end because all this is to do now is more just kind of download the reports, which I'll do in my own time. So then when we come into tomorrow, we can see how it works in the portfolio that way. Because some of these results like are actually pretty good with how low the drawdown is. Recovery, Sharpe ratio, all looking good, and we've got like loads of different markets working here. So really glad to see it. And the good thing is like we chose the first input that we optimized on the other side that worked there, and we've kind of just kept it to the same. Again, that looks not too bad as well. New Zealand yen. The only thing that I'd be concerned about is we need to make sure that our spread is on point that we're trading. So we need to look at the individual markets itself. Like, I'm not too bothered by this drawdown here because it's what we're doing is we're actually we'll collectively look at this in a portfolio. If we can see that it all doesn't work at the same time, then not good. What do you think about controlling volatility drag? Do you deploy any market neutral strategies? Personally, like I don't have any at the moment, but it's probably something I should look into. I don't know how best to answer that actually. I trade like loads of different breakout systems, so like collectively, they're kind of all uncorrelated now because I'm more focusing on different markets. But maybe something to look into. Probably a good point. But yeah, anyway, everything's kind of looking not too bad. If they all work at different points as well, it's going to be pretty good. Yeah, so that kind of works at a different point as well. I mean, the one thing that I'll probably say with this, it's not going to be like groundbreaking in terms of returns, but collectively it might be. Aussie CAD. Do we do Aussie CAD? It's not working too well at the start. Working quite good here. Yeah, okay, nice. Again, this isn't something that we've not looked at. Maybe it's better to sort of like hold them, but I'm quite happy with these sort of results across the board. Can see that it works more around the Aussie pairs. Again, another Aussie pair, Aussie, rather than your like dollar related stuff. Yeah, so this is good. This is really good, actually. Nikki, so again, within Nikki, I will change the contract sizing to see if we can get it to reflect the actual what it's doing, just to see. But maybe we do only risk 0.1% because we're going to have quite a lot of trades on this overall. Okay. Right, that's going to be my homework for tomorrow. I'm going to get all these reports downloaded and then I'll upload them to Quant Analyzer with the rest of the portfolio that we've already built here on the stream together for the charity Darwin. Let me actually just have a quick look. Do you think 200 trades and 16 months of data is enough to deploy the strategy on live markets to see how the execution quality is? 200 trades and 16 months of data is, I would say, is good. But then again, if you've only tested it for 16 months and nothing prior to that, I would be quite careful in the fact that, markets do change at times. So make sure that I would say that, that's not, you've got some sort of way of being able to filter out regimes and things like that. Yeah. Again, there's no harm in putting anything in a demo account and testing it the execution itself. No problems with that whatsoever. Okay. So just having a quick look at the chart at Darwin, we have taken some losses today. Okay, so we took a loss in Aussie dollar on our mean reversion, and we took a win on our Nasdaq. We have been kind of chopping around, so we were looking like it was going to come back pretty good this week, but we kind of went down again. So we're down 0.8% on the account. So that probably reflects about 3% in Darwin level. But again, if we can add some of these gapping strategies, I'm pretty confident that by the end of the year we'll be able to bring it back. I'm pretty sure, because we've not had any allocations as of yet, we're probably due the free one that you get. So could be quite good timing in terms of we can get it that way. But yeah, anyway, I'm gonna call it a day today. I think we've actually got something, probably one of the better looking things that we've got in terms of working across multiple assets. The downside is there's not that many trades to take from. Our regime follows fundamental software, but the data doesn't go far back. Yeah, okay. I mean, I think it would depend on what asset. Like, so for me, like if it's on currencies, it's going to be tougher because we go through so many changes with currencies. If it's more on like indices or gold, I would say it probably holds a little bit more weight. But again, it's hard to tell or hard to even like give any advice on that sort of thing because I don't understand, the way that you're doing your strategy. Forex and metals indices, okay, cross market, it could be. I mean, I would obviously always put it in the demo account forward test that way. I mean, it's all about like how confident are you with it as well. What I personally, if it was me, I would want a lot more data going back. But then again, that's just me. I'm more like data driven in terms of I want to see it work across multiple years. But also, there's going to be times where it probably won't work as well. You can't build a perfect. I think there's only one strategy that's worked every year, and strangely enough, this is the first year that's kind of underperforming. But previously, I've been running it for 3 years and it's worked very well, and the data before that worked very well. So it goes to show you that even like something that looks brilliant can go through periods of underperformance. Who knows? Might come back the next like 6 years and do good. All 3 rounds, 2 days holding average. Okay, yeah. I mean, if you can acquire more data, I would say that's probably the best thing that you can do to install more confidence in it. But I would definitely run it in like a forward tester and a demo account, something like that, just to see how the execution is for one. Also, does it reflect your back test in terms of stagnation period, drawdowns? Are the trades you're taking exactly what you're meant to be taking as well? So there's a lot to learn forward testing and demo to make sure everything kind of meets the criteria of what you're kind of looking for, because it's very easy to build a back test and say, okay, this strategy makes 50% return and it has a 3% drawdown. But then again, like the reality is, depending on the way that you've constructed it or sort of optimized, even in manual, it's easy to optimize as well. Like it's probably easier to kind of overlook certain things as well, being a manual trader, that you might not have considered. So as much as I think backtesting is brilliant, it's perfect. It gives you a good assumption as to possibly the word is it's possible what could happen again, but it doesn't guarantee anything. So the more that you can create a robust framework that it's like, rinse, repeat, like, for instance, like this, we're not optimizing it per asset. We're keeping it the same across the whole period. That way it's a lot more robust, and this tells us a lot more than say, okay, we're going to go to Aussie CAD. We're gonna edit the multiplier, the look back period. If we do that for every single one, yeah, it could find robust values and it could work. But this is a lot more robust this way than, sort of individually editing every single one. I'm currently forward testing until 100 trades is a milestone. It's unfortunate that the data doesn't go at least 2022. Yeah, I mean, it's going to be quite hard, I would say. But if you've got data from 2022 to now, I would say it's a good amount of data to go on. But yeah, let me know how your forward testing goes, and keep in touch. It'll be good to see how the evolution comes along with that. But yeah, anyway, that's it for today. I think we've got something good, as I said. Also, as I said, I'll do my homework and get these reports downloaded, get them into Quant Analyzer, ready for tomorrow, so then we can analyze these all as a portfolio together, then look at how does it look collectively within our bigger portfolio, the charity Darwin. So yeah, thank you very much, everyone, for joining me. Enjoy the weather. I know I'm probably going to go outside and probably chill in the sun a bit because it's quite rare we get to do that here, get a little bit of color on. And yeah, enjoy the rest of your day, and we'll see you tomorrow. Okay, thanks very much.